Hello, everyone. My name is Gabriel Ignacio. This is my partner, Jason Zhang. We're presenting our machine learning project for course 3253 with University of Toronto Continuing Studies. Our topic is Can Factor Investing Disrupt the Hedge Fund Industry? Mirroring global macro hedge funds performance through factor-based predictive modeling and ensemble learning. So we took inspiration from a Financial Times article that talks about how algorithms can be used to maximize and optimize factors that explain hedge fund performance. So, before we dive into the project, we would like to give our audience a baseline understanding of what hedge funds are. And eventually, hedge funds are is an investment management platform that enables wealthy individuals or institutional investors to diversify their portfolio and gain absolute returns that are positive, risk adjusted, and not correlated with market performance. So, the difference of a hedge fund with other traditional investment products, such as a mutual fund, for example, is that hedge funds often employ dynamic investing strategies that are non directional, uncorrelated with market variables. And that's where investment managers are paid for their skills in anticipating these movements. There's a question that we posted to our listeners and readers. Has anyone invested in hedge funds before? If you did, that means that you have at least $1 million and you've been investing for 3 years. Because in general, regulations in North America prohibit anyone from just investing to hedge funds. They normally are wealthy individuals and they require a lot of money and a lot of experience to take the risks associated with dynamic investing. So, why are hedge funds interesting to study? First and foremost, hedge funds, if you sum their asset under management in the US, is currently at 3 trillion US dollars, growing at 8 to 10% for the next 5 to 10 years. So lots of wealthy individuals and institutions are looking for ways to diversify their portfolio, and they're increasingly turning to hedge funds for that. And why is global macro hedge fund interesting to study? Well, the top hedge fund in the world, Bridgewater Associates, employ global macro strategy. If you also want to know how to make $1 billion overnight, just ask George Soros, the man who's known to break the Bank of England overnight by betting against the UK pound back in the 90s. And he also employed a global macro hedge fund strategy. Now, why are we looking at US global macro hedge funds? That's because each of the top 35 US hedge funds are greater than the entire Canadian hedge fund industry, which is comprised by 200 hedge funds and about 200 billion in assets under management. So the immensity of the amount of money that is being put on hedge funds, specifically US global macro hedge funds, makes it interesting to study on how what explains performance, and is it something that we can replicate. That's why our research question is: Are global macro hedge funds replicable using what we call the factor-based frameworks for non-accredited investors like you and me? So when we say factor-based frameworks, we are referring to the academic frameworks that hedge fund researchers have been employing for several years in terms of performing stock, in terms of explaining stock performance. So, what's our objective here? Our objective is to be able to ascertain if there's any dynamic linkages between market variables in the frameworks that we're talking about, that can potentially predict global macro hedge fund performance. You'll see here, hedge funds, they make money, tons of money, by reading the market properly. And the question is, can we actually decompose that performance into various variables and frameworks using algorithms, machine learning algorithms? Or are they neutral? Are hedge fund managers worth the dollar that you're paying for them? And can and their investment strategies are essentially non-replicable? The answers to these questions will tell whether we can systematically replicate results without hedge fund fees using machine learning algorithms. Now, let's talk about the data set that we're using. So, our target variable is the global macro hedge fund mean index returns from 1994 to 2018, about 300 monthly data points. And we're attempting to explain this performance using these three factor models in the academic literature, namely the Fama-French Carhart four-factor model, composed of market returns, size factor, value factor, and momentum as features. And then we have the risk-based factor model, which decomposes the coefficients into three broad categories: bond trending following risk factors, equity-oriented risk factors, and bond-oriented risk factors. And the third framework is the macroeconomic factor models, using traditional macroeconomic indicators like GDP, inflation rate, interest rates, etc. And we're using 300 monthly data points from 1994 to 2018 across the entire data set. So here we did the correlation plot between global macro hedge fund performance, the mean performance, versus market variables, small minus big, high minus low, and momentum variables. We put the distribution tables in here. And then the second academic framework is the risk-based model. We did a correlation plot between global macro hedge funds versus the equity trending, bond trending, and bond trend following factors. We have the definitions of these variables in the appendices, which we'll be uploading in GitHub as well, along with the code. And then lastly, we got the macroeconomic models that also we have the correlation plot here across multiple macroeconomic performance across all these three frameworks. You can see that there's kind of like a linear trend, and we'll find out as we talk about the machine learning algorithms. So I'm going to turn it over to Jason, who'll talk about the model building process.
Okay, guys, and in my process, where I want to introduce how we build the models. And right now I can understand about our data. Mainly we separate to three parts, and how we use algorithms and to build those models. First, I will want to introduce we build two types of models. One is regression, the other is classification. And for regression, we want to know how much we invest, and we can get how much return in the invest. And also for classification, we want to know we are win or loss based on our investment. So here we use different algorithms based on what we learn in the machine learning class. One is linear algorithms like linear regression and logistic regression, and also some nonlinear algorithms like KNN and SVM. Also, I have some decision tree classifier and Gaussian naive Bayes. And also I use the ensemble algorithm like the boosting and bagging, also have some voting. I want to compare those algorithms' performance, which is better in our case. So after the comparison, we can find some biased algorithms. And I make the process in the pipeline for the automated process. So first, we need a scaling for our numeric data, because we don't have category data, so we just to do the PCA for the numeric data transformation to get better performance. Also, we do the parameter tuning for the biased algorithms. And then we also to find the feature importance based on random forest. They have the measure like the feature importance based on the biased estimators. So we can see which features is better in different models. So let's look at some comparison based on different data sets. Like we can see right now for the Fama-French and risk and the macroeconomics, they all performance better in the linear and the logical regression. We can see the chart. It will be more higher in the accuracy rate. And also I build the best parameters for the logical regression. We can see the results. And also for the features, we can see farmer French, their feature importance is much higher than the other two types groups features. And also for regression, we also compare the same thing, and we can see the also linear regression also perform better in the RMSE than the other algorithms. And for features and the farmer French also perform better than the other two groups. So we can do some like summary results based on the table. We can see the farmer French, whatever based on the classification or regression, they all performance better. And the algorithm we choose is for logistic regression and for linear regression. And we can see those models is all linear based. It's similar like we do some data exploration in the beginning. Because our numerical data have a lot of features, so that's maybe the reason is the linear model is better than the ensemble or some other algorithms. So we can do some conclusion, like farmer French is the best to explain the global micro huge hedge funds performance. And for investors, they can pay more attention on the market performance, value premium, and the marathon. That's our key features they can consider about. And for the huge fund managers, they can explore these indicators for their marketing and strategies and the future plans. Yeah, that's it. Any questions about our case?
Thank you, everyone. You can look at our code in our dataset in GitHub. Thank you so much. Much appreciated for viewing the video.
Also, thank professors teaching us a lot